Hello and welcome back to InterTax Learning. When a U.S. company goes overseas, one decision to make is, will it be operating through a foreign branch or through a foreign corporation? Because that single distinction changes how it's taxed and what to report. Today, let's break down how a foreign branch of the U.S. company is taxed. First of all, a foreign branch is not a foreign corporation. It's not a separate legal entity. It is just the U.S. company doing business abroad. So the U.S. treats it as part of the U.S. company. If the U.S. company opens an office in Germany and doesn't form a corporation, that German office is a foreign branch. We often hear when foreign branches are referred to as foreign sales office, and that's sometimes the case in real life. The branch may be in charge of marketing, selling, and maintaining customer relationships on behalf of the U.S. company in the branch's hosting country. A foreign branch's income is taxed in the U.S. and abroad. On one hand, in its hosting country, the net income is subject to the local country's corporate income tax. Then, if profit is repatriated through dividend, a branch profit tax is assessed. Interest paid to the U.S. company may be subject to branch interest withholding. The actual tax is based on the hosting country's rules. That's something the U.S. company must be aware of. On the other hand, in the U.S., the branch's net income is fully included in the taxable income and is taxed currently. The foreign income tax paid can be used as a foreign tax credit to offset U.S. tax liability. However, that requires extra effort to keep track of. You can see why many U.S. companies try to avoid foreign branches, because branches create immediate taxation in both countries, and there's no liability shield. And this is why many companies choose to incorporate abroad instead. A foreign corporation is treated very differently than a foreign branch. We can talk about this separately in another video. Here's a simple example of a foreign branch. A U.S. consulting firm opens an office in Singapore. There's no Singapore corporation. It's just a registered office. Employees work here. Local taxes are paid. For U.S. tax purpose, all Singapore profits flow directly into the U.S. return. Foreign tax could reduce the U.S. tax liability. It's simply a U.S. income with foreign tax credit attached. All right, that's it for today. We have mentioned foreign tax credit many times today, so in the next video, let's start with the basics of foreign tax credit. I welcome your thoughts on these topics. Feel free to subscribe to learn more about international tax.